We got the usual hawkish remarks coming from the Fed, but also perhaps reading between the lines, the acknowledgement of disinflation in the supercore, for example. Would you take that as examples of perhaps a dovish tilt? What was your key takeaway?
Well, in the near term, they really signal there's no urgency for moving rates lower. They're in a wait-and-see mode. But I think the underlying message here is don't get too excited about near-term rate cuts. We're really awaiting a further disinflation of the economy. We're going to wait a few quarters until we actually start to look at easing policy. And I think that was a good reminder to markets that the Fed's job is not done yet. They have a 2% inflation target. There was nothing in Jackson Hole suggesting that they would relax the inflation target. So there's still a bit of way to go to get actually inflation back in line before you can contemplate rate cuts. So middle of next year seems to be sort of a timing we have in mind. And then, of course, you might see quite rapid rate cuts coming, but it would be a while before we actually start that easing cycle.
Especially when we have a resilient labor market. We are expecting the jobs numbers this week.
That's right. All focus is going to be on the employment numbers here. We have seen some softening in job growth in the U.S. It's not perhaps quite as strong as we initially thought, but still, the U.S. economy is still generating jobs. The unemployment rate, of course, being extremely low at that. And it's very hard for core inflation to come off if you have such a tight labor market. And so we're probably going to need to see a rise in initial claims, perhaps. We need to see a bit of a loosening in the unemployment rate in order for the Fed to say, you know what, the underlying inflation risks are manageable, therefore we're going to cut rates. And again, it's going to take a while before we get to that point.
Overlaying all of this is what's going on in China, right? Are there policy measures at this point that would be effective?
Well, we've seen them come out with a host of measures all the time. We just see, for example, a cut in the stamp duty, but it is still very incremental. Remember, the economy is suffering from major headwinds, particularly from property, but also from exports. And it does take a bit more to really get ourselves out of the rut here. Probably more fiscal spending is needed, not just sort of regulatory changes, measures to help investor confidence. Of course, that's always very helpful. But if you want to really address underlying demand, you have to see a stabilization in the property market. And we're not quite there yet. There are measures in place, but we have to see how much traction they really get. And likely they'll have to do a bit more in order to stabilize overall growth and expectations in China. It may take into fourth quarter before we really see those measures gain traction. So we're almost then at the end of the year before you see that stabilization and growth really come through.